Welcome. We have a newly confirmed chairman of the Federal Reserve, Kevin Warsh. Let's talk about his policy views and the role of the chairman of the Federal Reserve. We've had many Fed chairmen serve under different presidencies and different administrations, including some who have served multiple administrations. And the role of Kevin Warsh now, as head of the Federal Reserve, is to oversee monetary policy, which includes the dual mandate of maintaining full employment and price stability. Fed policy the last 15 years, I would say, has been highly controversial. Hoping to increase economic activity, the Fed has created new dollars to buy financial assets, primarily treasuries, but also mortgages and other instruments, to try to increase financial system liquidity and lower borrowing costs. This caused the Fed balance sheet to increase over 800% in 11 years. And then over the last 3 years, seen that balance sheet retract slightly and now stabilized at roughly $6.7 trillion, still a very elevated balance sheet. Now, Kevin Warsh believes that the Fed should retrace its steps once financial conditions normalize and the crisis is over, as it clearly now is for the great financial crisis and COVID. And if that continues, then what we could see from the Fed balance sheet is a tightening, which may short-term result in a stronger dollar and modestly higher near-term interest rates, and borrowing costs that over the long term, however, could remain lower than they otherwise would have been if the Fed can reinstill confidence in a more prudent long-term monetary policy approach. Kevin Warsh has also stated a belief that Fed policy, especially since the pandemic, has contributed to the untenable increase in the debt and deficit. Fueling the ballooning national debt has been an increase in the money supply, shown here as M2 money supply in the thin blue line. And since 2020, M2 has increased by 45%, a 45% increase in all dollars in circulation. And this is without a doubt the primary reason why we have sustained higher inflation. The latest headline CPI print was 3% year over year as of April 2026, with core CPI, consumer price inflation, at 2.8%, both well above the Fed's target of 2%. This has created a very difficult policy backdrop. While many at the Fed and in the markets had previously been expecting further rate cuts, Fed fund futures now reflect the possibility that the Fed may need to consider a rate increase by early 2027. This change in inflation and interest rate expectations is nothing new, and a big part of our job is to assess the changing dynamic of market conditions and how we can position your portfolios as well as possible for the unpredictable future. Thanks for watching. Enjoy today.